Another live stream.
Huh?
Another live stream.
Yeah, the afternoon session.
Oh, I thought it was good for that. I've only seen one on the...
Remember, it starts at 2 o'clock every day, doesn't it?
I've only seen one on the...
Right. Okay.
It's a good Monday.
It is a good one then.
This fucking beats 9 to 5, I'll tell you that.
There you go. Right. Happy Monday, everyone. Oh, good times. Right. It's profile week, so we'll be doing a fair bit on profile this week. Get your questions in, as always. Anything you want me to cover, we'll cover on profile. Seen a couple of questions come in. This is just where we were last week, so I'll just follow on from here on the ongoing sheet. We'll cover a few little different bits and pieces. I'll put a couple of things up that I've seen.
They can hear you, but I think yours is muted.
No, battery's gone. Right, apologies. Battery's... No, we've got a bit of battery, so we're all right. Yeah, we'll cover off a few questions, cover off a couple of things that I've seen so far today. No, they're all right.
They're okay?
Yeah,
they heard all that though.
Right, all good then. Okay, we'll keep our eye on. There's a couple of ones that so we've got my eyes on today. The S&P at the moment, right where you are, for sort of either this is support or we go lower, and I'll explain that in a minute. And then oil, and we're looking for it to go higher, but it's just not doing it. So I'll bring that one up in a little bit as well on the what I call a should versus an actual trade, and the whole sort of concept of, well, do you stay in a trade because it's doing technically what you think it's going to do, but it's not actually looking like what you want it to look like, and it's always this kind of way up that you have to work with. Right. Just incidentally, that oil trade is the move from 72, looking for it to go up to about 68.14. It's really, really, really making a meal of it. Right. Onwards, a few questions, so I'll try and cover these. I've stuck an example up here of some profiles, so just in case anyone does have any other questions on the specifics of what everything is. But I'll cover off these questions from Darius and try and relate them back to some of the stuff on this profile. Right, is there a certain or minimum number of previous days profiles that should be looked at? No, I don't think there's a correct number. You have to look at it in terms of where you are and what's currently going on at any point in time. So if I'm looking at, say, and the reason I put the Bund up was it's quite easy to go, you don't need to look at much any further back. With the Bund, I think that's about as far back as you need to go. So that takes you back to the beginning of last week. That's pure coincidence. It's the beginning of last week. It's not because I'm going back a week. The reason I say that is because where we've opened today is down here. If you're going up, then crucially, you've got to get back inside of last week. Now that we're inside of last week, yes, there are profiles lower down. If you go back over there, there's profiles lower down. Do I care about them at the moment? No, not really. Until we're back down here, I don't have any need to go poring over those profiles and coming up with conclusions and ideas and whatever about them, because we're nowhere near. We've got a lot of work to do to get down there. So at the moment, and you do the same with like an hourly chart as well, there's no point in knowing the levels on the S&P in the 5400s because that's 500 handles lower. Does it matter? No. You've got a lot of time to work out what those levels are before you get there. Even if it does it today, it's still not going to do it in an instant. So you've got time. So I'm going, well, what am I interested in? Well, at the moment, that level really matters. As long as you're above there, I don't need to look at any other profiles. And at the moment, on the upside, you've got these highs, single prints. I don't need to look at anything else beyond that either. If we get up there, if by the end of today we're up here somewhere, then tomorrow I'll be a little bit more interested in what did happen previous. But don't go spending too much time looking too far out. Yeah, if you want a bit of guidance, if you want to try and create a rule or put a number or a quantitative way of looking at it, look at an ATR, or even if you don't look at an ATR, which is average true range, it's a volatility indicator, even if you don't look at that, keep a track of whatever market you trade and just write down the range at the end of each day. So if you write down, okay, we've done a 50 tick, a 40 tick, 60, 70, 70, you know that roughly the range is somewhere around about 55, 50 ticks. Double that and then look at where you can go from there. I don't think there's much value in looking much beyond that. Otherwise, you just get into the realms of looking for things that, well, may or may not happen, but are probably more unlikely than likely to happen. So that's how I'd kind of try and sort of determine that. I'm not entirely sure what the question is here, so do clarify this, but I'll put my interpretation of this. Should every day be combined with a previous day on my chart on a daily basis? If you mean in terms of merging the days together, I would say no. I want to know distinctly what the previous days were individually. For example, here, that's an inside day, and I do kind of want to know what the top of that was. I don't see that there's a problem in terms of your analysis merging things together, and I might bring the bin chart up and do that in a moment. But you can kind of visually see this anyway. So what I mean by that is these 2 days have overlapped. Well, one's completely inside the other. Value is completely inside the previous day's value as well. So from an analysis perspective, you could merge those two together and say, well, from a value perspective, nothing's changed. Yes, we've spent more time there, but ultimately people have traded in that same area. That's where value is perceived. You could merge those two together. But visually, you can see certain things anyway. I've drawn the box around that because visually that's value over these 2 days, and you could even narrow it in if you wanted and sort of say it's more like there. You could also just see, if you just look across, that there's not a great deal of volume done in this kind of area here. So that becomes quite a distinct level because there's very little volume done there. There's lots of volume done here. As is mentioned in the videos, areas of large volume, market can trade through. Areas of light volume, you can get stuck at. As it seems at the moment, 95 is an area that it just doesn't like to stay at. So there are situations where that low volume can maintain or remain low volume for long periods of time, where the market just doesn't stay there. One thing that you might look at, again, if you're going to try and merge things together, and you can't really merge this day with this without merging them all together, but visually you can kind of go, well, that balance there has balanced this lack of balance, if you will, and ultimately sort of kept that all in one place. So again, you could look at this and go, well, that's quite a well-traded area. If you get inside there, reasonably fair to assume that we could well move up through that zone, a bit like the way we went down through it on Friday. Similar to the way we went up through this area this morning. So that's how I try and sort of interpret them. I don't mean you need to push them all together to do that. You can kind of visually work out those zones yourself anyway. And if so, should they be left separated as weekly profiles? Weekly profiles should be, all right, so, sorry, they were my answers in italics. No, I would do your weekly profile as a completely separate thing. Personally, I draw a weekly profile as like a custom drawn profile over an hourly chart, rather than have a profile chart. The reason for that is, and it may be different on different platforms, when you start creating weekly profiles, at least with mine, it becomes very, very heavy on the computer, and you end up, if you go, I've done it before, you accidentally don't change the number of weeks and it tries to compute the last 100 weeks of profiles. All of a sudden, that's what, 8 years of profiles. It doesn't like it, and then it all gets upset and crashes and you make a mess. So at the end of the day, you don't need to know what the profile looked like in 2017. It doesn't matter. So like I said, I would generally just get your chart up. And where's my profile? There you go. That's my profile from last week. So I just draw them on like that, and then have one for the previous week. So then it helps you just see where values sort of traded. It also, from that combination, like I was saying, in here of the value down here and then value up here. So you've got, that's this bit of volume in here. Whoops, you can't quite draw. So basically below 95, and then you've got more volume up here. Therefore, if we are going to get stuck anywhere this week, I don't think it will be a wild assumption that we could spend some time trading in this area here, the sort of 133.80s up to the 132.80s up to 133.20s. Could well be the rest of today. That we just get stuck in there, and that becomes the zone to trade. Build some volume in that area, and after doing so, then you can move. And that's often a sort of common feature. And then once it's done that, then we move on. That's where we've gone to now. So we have then continued onwards and traded up into this area. Why that's not updated, I don't know. Oh, that's not updated because it's an image, that's the chart. There you go. Following on from, if anyone didn't see the 1 o'clock stream, this will come up more tomorrow when you do stuff on day types. This in the bund is, I think, and you can never be quite absolutely certain, but it's between a trend and a liquidation day. I think it certainly was a liquidation day up to here. It's now particularly if it puts value in higher, I'll bring the profile up of where you currently are, as it is doing, then you could look at it and say it could still be a trend type day. The concept of a trend day is you move up in pockets of volume ever higher. This is basically people buying and shifting value up and up and up and up. The reason that it shows up in that way, and I'll see if I ping this onto a 5 minute, it'll be a bit more illustrative. The reason it shows in that way is that people who are really trying to buy, and the bit that puts me off calling it a trend, not from the way the profile looks, but from the way the chart looks and the way it's traded, is it's light volume. It hasn't gone through sort of wide pockets of just sideways action. It has been broadly just a straight drift, which is not particularly trend typical. The idea of a trend is basically if you've got to buy an absolute ton of bonds, I'm not talking a day trader who wants to buy 200, I'm talking you've got to buy all day. You don't come in and just start hitting market. You also don't come in and start showing everybody your size. You go, look, I've got 10,000 to buy, because sure enough, the market is going to run from you, because everyone sees that and goes, just buy it now, make them pay up, and you'll end up paying up miles. So someone who really wants to buy will buy, and as soon as they sense that people will actually sell to their bid, they sit there and just buy slowly. Once they stop getting filled, they then push it up, and there is an element of if you push a market quickly, you find people to react. If you move slowly, no one reacts and sells, so you go bang, 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 up 10 ticks, some people start to sell, now you've found your sellers, place your bid a little bit lower, let them come and sell, and that's how you get these little pockets moving up. So what this helps you is to go, okay, well today, if I think this is a trend, one, my assumption is this will close at or near the high. And when I say close, I would say 415. I've looked at a lot of trends in bunds in the past where if you stay in until 9 o'clock, which you could, you might end up 10 ticks better off. You might also end up 10 ticks worse off. I don't think there's much value staying all the way to the end. So if you go till 4:15, give it up there. I don't think you get much value for staying in for another 5 hours really. So you might as well give it up there. If that's the case, then if you believe this is a trend day, you don't know where the high is. It could finish somewhere here. It might also finish another 50 ticks higher. So the point is you don't give up. You just assume this is going up and you stay in. Easy to say now. The only way you ever really make money out of a trade like that is you've got to say that as it breaks here and go, I think this could be a trend day. Particularly, I think the big clue, if you really want one, was there at 65s. When it pops a little way up, so that'd be around here, starts to build lots of volume. If I draw the profile around it, I just think it's quite a helpful way of looking at it. If you've seen it do that, moves up, and then you get that jump there, and the volume starts to print higher. As soon as you've got that, then you're thinking, this could be a trend. It's a long step and a big leap of faith to say it's a trend day from that, but what you're playing on is the basis that, well, if you buy it here and call it a trend, your stop is just back below these previous highs, which is essentially below last week's low. So you're taking maybe a 6 or 7 tick stop on the basis that if you're right on this being a trend, who knows how far this could go? 100 ticks maybe further. So it is hard in the sense it's an indefinite risk reward, but you're playing on the basis that, well, you're going to call it a trend. If you're wrong, it doesn't have to trade back down here to be wrong. It could very quickly zip up to the high mid 90s up here and then start to rotate. And if it does that, you go, okay, it's a liquidation day, I'll give it up in the low 90s. It's not the trend that you were hoping for, but either way, you're 30 ticks on side before you make that decision. It's just one of these that now, if you want to call it a trend, it's very hard to justify buying it up here and going, oh yeah, it's definitely a trend. Because you could buy it up here, see it trade back to 13, see it trade back to the high, and at the end of the day, you look, yeah, it's a trend day, but you're gaining nothing for buying it now because there's not much left in it. Doesn't mean it won't, but I think it's more 50-50 now what's going to happen. Whereas if you're buying it down here and you're calling it a trend, it goes very, very little distance down and you're wrong. Anything that goes up, you're right, and it's just a question of to what degree, i.e. how far is it going to go.
Richard, just one quick question.
Go for it.
The price highlighted in blue, which I think is 1 something 13, is it 153.13? What's the yeah? Where we then break out at the there.
There, yeah. Would
you still buy that break if you weren't in that trend and you hadn't really got a decent opportunity to get into that, because it hasn't really fallen back much until just before that? Provided we're still, I guess, what would you say, less than 80% of the ATR for the day? Would you still see that as a valid breakout? How would you evaluate that to say, is there any more juice left in this or not? And looking, because you've got the high at the top left of this.
Yeah.
Run into.
I think you could. It's one where you definitely don't do it with the same level of conviction that you might have lower down.
Yeah.
But I think you could make a valid point that it has consolidated here, so it has spent a bit of time.
Yeah.
You've got another range to move up through towards, moving through these single prints. So I think you could make the argument that yes, there's some value in the trade. There's not going to be a gigantic stop on it either. So you could probably again play the 13, 14s with a stop down at maybe 8s, 7, 8. So you're risking 6 or 7 ticks for a probably 25, 30 tick winner. So I think there's value in it, but because of how far it's gone at this point, I wouldn't be super convicted, i.e.
Full trade.
it might be, it's a smaller clip trade, but I think it's one that there's not a huge amount of downside in taking it on, so you might as well.
Okay, thank you.
On that note as well, Rich, do trend days usually start early, or can you get a trend late that starts late in the day? Probability-wise?
Probability-wise, no. You can get them. It would probably be something that's initiated by some news, because if somebody's got lots and lots of business to do, the earlier you start doing the business, the more likely you can get the business done. If you start late, you're going to struggle. So it's more that people need to change their perspective and do something about that, as opposed to someone's going to wait and wait and wait and wait. Ultimately, a trend day also comes when there's an imbalance of people wanting to buy or sell. Because let's say there was equally, if we're going to call this a trend, there was equally somebody who really had loads to do to sell. All you do is end up with a day like that, where it could well be that you've got someone who really wants to buy and someone who really wants to sell, and it just basically bounces up and down. Because one of them just goes bid, 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 and the other goes offer, 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 offer. It never gets out, and it never gets out on the downside, and it just gets trapped. Essentially, everyone's happy. This one is one where clearly there isn't a great deal of people wanting to sell. Somebody really does want to buy, or multiple people really want to buy. It's not going down. And so it then just drifts on and on and on. Right. Darius, merging day. Yeah, so Darius, I wouldn't just go merging days together. I think it's one of these things you could do from an analysis perspective. Oops, one second. There we go. Pull this one back in. You could do it from an analysis perspective, kind of merge, where are they? Merge that one there, you can see how that then starts to balance out. You've also got, if you merge that one, you start to merge those three together, and you can see this is clearly an area where it's finding quite a lot of value. Where you've got somewhere that's found a lot of value, it's harder to break out of, which again could dispel the idea of this breaking out towards the upside. I think the problem you have then is you can always end up talking yourself into or out of whatever you want. You're better off to go, yes, but on today's evidence, this looks more like X, Y, Z rather than another way of doing it. Your alternative is you just merge it on a weekly basis, as you suggested. But for example, I would see very little value in merging this profile and this profile. I don't think you gain anything from that, because these are two very distinctly different days. You could, over the course of, or after the fact, merge these ones together. Like that. Just to give yourself a better sense of where value is. So you could then look and go, well, actually 91 through the single prints into value, we could sweep all the way through. And by the way, that is a horrific high up there. So
Horrifically bad.
Yeah.
Because there's been no rejection, there's been no tell, it's just a big fat stopping price.
Flat top, yeah. It's not, it will break that. I'm very confident in saying that. I can't tell you when. That's the only bit I can't tell you.
Why not, Richard?
Well, soon. I tell you when it's going to break it, when it gets above 91. If it gets above 91, then it's going. Okay. So it's kind of a, it's the target without an entry at this point in time. And you could buy it all the way down here and go, well, it's going to do it, but it could go a long way down before it goes up. But I'd be pretty confident, get up there, and you'll get, I say everybody.
And Kerry Hindsight will be in tomorrow with asking.
Oops. Yeah, I think, you got 91 and you got that 97, so get over this little bump of volume here. There's just nothing to stop you. The fact that the VPOC's at the high as well is also an attraction up. So I think it's on. It's just a case of, you've got to get to a certain point before this is a viable trade. 76 is probably your first point. If you get over this, you're through all of these previous profiles. then you're only really dealing with these three. So if you're above 76, the attraction's towards the high volume anyway. If you get there, it's really hard to see it not going for the high. So you could try and play it from even this low down to around 76. You could play it from higher up, and this is your classic situation with these flat tops, that people are going to get increasingly keen to get onto this because everyone expects it's going to go pop through that, possibly up towards these previous single prints, which are from over here. That's the trade. So everyone can see the pop and the jump and the nice quick move. So then it's a game of how can you get into the trade. What happens is the closer you get to the top, the more and more people start buying it, the more and more people are long just below the top. That does run the risk that it goes tick tick through, therefore it has completed the poor high, it has broken it, and you found out there are no more buyers, and then it goes and falls straight over, which is why I'd put the onus on. If you can get in sooner and it trades, let's say you're in from 90, it trades 25, wherever it is, yeah, 25 is the high, 6, 7, 25 offered, 24 offered, you're okay because you're still 35 ticks on side. You can get out. If you bought it at 25, thinking, yes, this is going to explode through the high, you're in trouble now, and you're going to have to run for the exits pretty fast. So the better positioned you can be going into it, the better off you are. But yeah, it's a shocker of a high, that one. Right. Okay. Right, I'll answer quickly Ian's one. Do you prefer TPO or volume points of control as point of reference, and do you put more significance on longer and untouched points of control? Okay, so points of control are the points where either the highest volume has traded or the largest amount of time, dependent upon which you're looking at. So time is the point where the most letters are, indicating that, well, more half-hour periods have traded that price. Theoretically, you spend more time there. The volume one is where the most volume's been traded. For me, I think volume matters. Volume's far more important because that's what people have actually done. You could spend a long time somewhere, and as long as the market does a couple of trades, it maintains value there. I don't think that's particularly indicative of anything, apart from the fact that, well, people didn't do anything. That doesn't suggest that's good value. I'll give you an example of if you bought a car off sort of a friend or family member, that's probably not indicative of value for that car because you probably got it cheaper than what you would pay for that car if you actually bought it in the market. But that one trade at a really low price, if nothing else trades for a while, isn't indicative of value because no other trades have happened. It's indicative that you got a good deal and that's it. So I would put the weight much more on the volume over the TPOs. The letters are helpful for seeing sequence and things like single prints, stuff like that. I think that increasingly they have lost importance when it comes to actually indicating value. They're very useful for things like bad highs and bad lows though, and indicating a tail. For example, that's a very clear tail, i.e. a rejection. From a volume perspective, it's not so clear because you can't see that, you know, it has volumes tapered off, which is what you'd want. So you could assume that it's rejected, but it's not as clean looking. So therefore, I might interpret that to be a tail and somebody else might not. If you're looking at it from a letter perspective, it doesn't matter who you are, that's a tail. So they're a little bit more sort of clean in that respect of what they show. You know, the same with a bad high. Those bad highs, you can't tell that it's traded there on 4 different half-hour occasions and not broken. Even if the volume is higher, you know, you never want to see a chunky volume at a high or a low. That's always a good indication it's not the high or low. You could argue it there today in the Bund. So you assume then it will go higher. But, well, it did actually, because we saw it a minute ago. But it's hard to really see what's actually happened there. And, you know, a 4 TPO high is going to be seen as much more clean break point than, say, a 2 TPO high that's done a ton of volume. That'd be the way I'd sort of interpret the difference there. Right, come back to some of these questions. Lastly, and also, this segues quite well, to alleviate the issue of there being lots and lots of letters giving you a somewhat poor indication of what's going on, I would generally use cash session hours only. The reason for that is, let's say, here you go, I'll ping up an S&P one, for example. and the S&P is probably not the greatest example of this, but that's just a cash hours one. Now you can change that to a pit session, to a full session, but I think what it does, it loses a lot of information, because this also shows you where gaps are. You can switch it to a full session, and then you start, like for example today, getting this huge sort of sense that there's loads and loads of volume and value in here, but really we've only been open on the cash session for an hour, yet it's suggesting that all your value's here. And yes, we haven't moved far from there so far, but it wouldn't take very much on a cash session to shift value away from here. Whereas when you look at this on the face of it, I would look at that if this was all cash and go, it's going to really struggle to move away from here now because all the value's so well established. It's probably not going to be too difficult to move away from there. Likewise, say over here, that would have looked like value all down here, and then very quickly it would have shifted up here. The falling back happens to kind of keep value down here, but if this had stayed up, it would have very easily shifted value higher. So I don't put too much weight on, let's see if I can split this. You see there, so that's all of the overnight and the sort of first hour of the cash session. And so in the first hour of the cash session, you've managed to shift in 1 hour of trade, which is quite directional, the average, or you sort of overwhelmed the volume that was done down here and put it up there in just an hour, which gives you a sense as to how significant the volume is on the cash session. Yeah, that's what the best part of 10 hours worth of trade, and your volume down there at the time, I'll try and hover it over. Your peak volume down here was 4,000 contracts. Within an hour of the open, you've done 11,000 contracts higher up. So that's taken 7-8 hours to do 4,000. That's taken, well, it's only on one letter, under half an hour to do 11,000. So it kind of gives you that illustration of how insignificant a lot of the overnight is. Right, let me ping that back.
Richard, can I ask a question?
Yeah.
To what extent do you describe to believe in this following hypothesis, is that the market moves between, like, there are certain size players that move the market backwards and forwards, right, or what they want to do essentially, yes?
Mm-hmm.
And the overnight session is a really great opportunity for them to move the market on lower volume, to catch people offside, to drive a response. It's often the opposite of, well, is the thing that they need in order to be able to initiate positions in the other sense. That's why kind of, how do you, what's your logic as to why prices move in the overnight session, now more so in Globex sessions? Because it's not like, particularly in a scenario where there's no reprice, like there's no news that causes a temporary reprice of the asset. It's like, hey, it's just moving around. Often it moves around to try to catch out people, right, and to set up for the day.
I think there is a bit of that. I think there's definitely an element of, you could drive a market in lighter volume periods to where you want it to be. You know, let's say, I'm trying to think of a decent example of it.
Steve, people still need to do business though, don't they, if they need to trade at the end of the day?
True. Yeah, someone's still got to do it. But I guess there's part of an element of, some people are going to have to do some business, but if you can kind of push it to make some people do the business rather than them trying to buy it lower down. If you look even here, let's say for example, it drifts it up. If you're somebody who really wants to sell, yeah, there could be some value in, you just add to a bit of that buying, get some more people buying so you can sell up here. It's always a difficult one to ever know if that was originally the idea, or the other interpretation of it is some of these people have come buying it thinking, yeah, we're going to be able to push it up here, gap it over the recent few days, and boom, off we go. Now, I don't mean it matters which way you look at it, whether this is people trying to push it up so they can sell, or whether it's people trying to push it up so that it explodes towards the upside. Whichever way you interpret that, if they don't get the move they want, then you get the reversal type of scenario on it. Yeah, if it's someone pushing it up so they can sell, well, as long as nobody then drives it on the open, then they will sell. And if it's people pushing it up hoping for the move, if no one drives it up on the open, then they'll sell as well. So I think it doesn't really matter the reasonings as long as you've got an idea of why you think it's done something, because ultimately you're never going to be able to prove or disprove the idea. It's yeah, exactly. So I try not to speculate too much about who's done something and why they've done it, on the basis that it's completely impossible for me to actually ever know who's done something and why they've done it. That's reasonably good example of one where that's the cash session closed, rolls it over, surely it goes down, and it doesn't, and then you get that reversal back up. You probably got a similar thing, or you had a similar thing on Friday as well. They drove it up. It starts to go, and then once it falls back through the open, then everybody who thought, oh, this is the one, off we go. They all get caught out, which is one of the things I think I put that one up. Right. Just a question. Has anyone managed to set the volume profile on time charts, not TPO, for European cash hours, i.e. for DAX? I'm only seeing these options. You'd have to probably go custom chart. That would be the simple answer to that. Yeah, I would just go draw a custom profile. Also, on the point of monthlies and weeklies, I won't bother at all. I don't really see the value in seeing a monthly profile. It's too long distance, and any areas of, say, low volume or high volume are going to be so wide that what are you going to do with it? I don't think it really offers you any particularly solid trade opportunity or clarity of information. A weekly stretching it in many cases. Right, I read this one before, so I think I've kind of summarised it, but I'll try and sort of have a quick look at it. On the exit of a move, you say that you're waiting for a tail with single print letters to form, whilst the move continuation will be multiple prints at extremities. Yep. As the letter prints, you'll be seeing a single print at the time. If it's a continuation of a move, price has to stay trading at the extremes for an extended period, whereas with the end of a move, with a tail forming, by this time you can see the tail has formed. So this is the kind of question of, well, perhaps if I can, the S&P might illustrate this for us in a moment actually, so I might come back to that. This is the whole idea of, let's say you've got a market that's done this. So you're trading sideways, so your profile is going to look at this point in time, something like that, i.e. not much volume at the bottom, more volume towards the top. Be easy if I drew it like that. So that's what your profile is looking like. Let's say you go higher now, so then your profile is going to extend up. And as it extends up, that is going to be a single letter. And the question being, well, how do you know whether this is the end of a move and a tail, or the beginning of a move and you're going to do that and move up, i.e. build your profile to look more like that? So sorry, that should be there. Ultimately, you don't. You can't call a tail until it's happened, which falls back onto the age-old question of how do you know it's a real break, or can you spot a false break? I don't think you can spot a false break until it's happened. Until this falls back down here, and get rid of that. Until this falls back down here, that's not a tail. It's a potential breakout. So it's about the next step of the move. Yes, for a market to go higher, you're going to need more time spent up here, and then it can keep going. Trend type move. So the way to kind of try and look at it is, it partly always comes back to the question of, well, what were you expecting to happen? I'm never going to be able to play this down if I think this is a significant level, we've broken it and we're going up. Even though at that point in time, it is just a one letter tail. It is, but it's only a one letter tail if that letter closes back down here. And if it doesn't, then you're going to print the next letter somewhere up here, which then creates a single print in here. So there's always this element of the next step before you can really say what it is. This is where and this is where I think profiles, not tricky, but easy after the fact to go, oh, well, look at that, it's a tail. Of course you should have been selling it. I think with a tail, you can't, of course, be selling it. So there has to be an element of you overlaying your belief or understanding or expectation of what's going to happen next, and then waiting for that to happen, rather than after it's happened going, oh yeah, look, it's a trend day, by which point we're now trading up here and you've done nothing because you're waiting to go, oh yeah, look, it's a trend day. So there has to be an element of that kind of understanding of it. The bun might have been a reasonable example of this morning. And in fact, actually, I'll bring the S&P in, because I think this is probably a good example at the moment in terms of where we are. This has stayed inside the initial balance. Now, on that basis, you could look at this now and go, okay, at some point, you're going to get a single print tail. I think the stat is 99% of days will break the IB on one side or the other. So I'm very confident to say you will see a single print tail at some point. As that is forming, you don't know it's a tail. So this is where you then have to make a decision as to what you think the result of that's going to be based on a wider view of where you think the S&P is going. So if you get the tail to the downside, So let's say we go down here, D prints come down here. If that happens, well, at what point are you going to say, I now think this is going down versus this could be the low of a tail? So it still ultimately comes back to your understanding or conclusions about what the market's going to do today. On that basis, I think you could look at this and go, well, if you filled a single print, drop onto these previous highs, you could buy that. And so then you'd have a D print tail, whoops, down to here, you buy the bottom of the tail. You're essentially playing for that to become a tail, close back up here, in which case you're long at the low of the tail, you possibly call the low of the day. If you don't think that it's going back up, you don't buy that. That's just wishful thinking buying that, or stupid if you don't think it's going up, don't buy it. If you think it's going down, then when it breaks through here and it starts to print the D prints inside of these single prints, you go, I think this is going down, sell it, put your stop back inside the IB, and if, who knows, half an hour later, it could be 5 minutes later, if this breaks right at the end of the D print, well, or C print as it could be, yeah, you could do it in 10 minutes, you could break this on the C print and then start printing a D print down here, then you've got the single prints, which are an indication of the beginning of a potential trend. So there's got to always be this element of, you don't know which it is, but you can already overlay what you think it probably is likely to be based on your other analysis. And look at it like that. I wonder if oil might have something like this at the moment, actually. Depends what time it broke. And there you go, you might have a little bit of an illustration of it there. So if you were playing this towards the upside today, it's a little bit trickier because you're playing it with inside the IB. But ultimately, if you got the A print and then you buy the B print on the break of the high, basically, as it would be, you buy it on the break of the high, you're essentially thinking to yourself, as the Bs go up, it's going to leave a single print. Now you've got to wait half an hour for it to actually leave a single print, and actually you've got to wait an hour because you've got the Bs that create the single. The C, as long as it doesn't fill it, shows that there is now a space of no trade, and then the D is the bit where you can go, okay, yes, this is now a single print, it's not a tail, we are going higher. Similar now, if you think this is it and you don't think we're going above 68.02, you could look at that and say, well, that's printed a tail now, the C prints. You could sell from the bottom of the tail, what's that, 90, put your stop above the high and say, yep, I think that's it. It's called the top, it's failed to break the IB, it's left a tail, it's going down. So you could interpret it like that. But ultimately you can't, well, you could sell it up here and hope that it's a tail, or you can now wait for the D print and say that is a tail, and it's a tail until it's filled. It doesn't mean it has to be. The D prints could go and break the high, in which case your tail is now invalid. So there's always got to be an element of you're assuming it is something on the basis of the information you've seen.
You're pretty preemptive, I guess.
Yeah. Otherwise, if you wait for too much information,
You just have value all the time if you won't.
yeah, you found out the information, you go, oh yeah, look, it's
Everybody else.
yeah, it's what you thought it was, you know. The perfect analogy, but it's along the lines of, well, if it quacks, it's a duck type idea. You don't need to actually see it. It's pretty fair guess it's a duck. You could be cheated, it might be a minor bird, but it's probably a duck. So assume it's a duck until proven otherwise. Look at it like that. So that's the way you've got to try and look at it. I'll talk about that in, onto psychology a bit, on the difference between probability and propensity, because people rely too much on probability, and by the time you can see the probability of something happening, well, it's happening, in which case you've missed it. You need to be at the point before the probabilities become clear, otherwise you're not gaining any information. So I hope that kind of answers that one. Ultimately it comes down to an assumption, which brings me on to actually what I was going to talk about with the S&P today in terms of assumptions. So we'll do more on day types, but I thought what I'd try and look at is the way a profile is actually created, in the sense that it's quite easy after the fact. If you looked at yesterday's profile and you had all the letters compressed back together, you could call this a double distribution. You got distribution here, single print, distribution here. So kind of capital B, if you will. So that's pretty straightforward. A double distribution is exceptionally difficult to preempt, in the sense that, well, there's no reason to assume today that we're going to distinctly trade here, then here. You assume that you're going to do one thing or another. I would look at the way it traded on Friday as well, as this is much more what I would call a technical double distribution, not a more traditional, if you will, or typical news-based double distribution. The idea of double distribution generally is, well, everyone's happy here, and then news comes along, something changes the market's understanding of what's going on, that causes direction, and then everyone goes, okay, well now we price the news in, and it trades down there. Looking at other markets, which is essentially always the best way of judging whether this was news or not, nothing else had a particularly clean directional move at the same time as the S&P on Friday. So I would make the assumption that this is technical. I looked up to see if there's any news at around about 5:15, and I couldn't find anything that seemed overtly S&P specific or broad generally. So I'd say it's technical. What you've got essentially to start the day with is an open and a strong move up. I would have been very confident on Friday to have said, and in fact I possibly did say on Friday, that's the low. You can usually assume that the initial balance will call the high or the low of the day. I would have pretty confidently said it was the low because the fact you opened and went straight up is a classic open drive trade. So on the back of that, I would still, even down to this point, be saying, I still think this is the low. We're probably going up. A lot of other people look at it like this. There's quite a lot of people, I know particularly in America, there's a lot of people who trade these types of things very formulaically, in the sense that you get the open drive move like this, drives up, breaks the high of this first 5-minute candle, and people buy that, and they buy, and they put their stop there. And essentially the idea is you play for a trend day. You'll get stopped out on a few, but a lot of them won't stop you out. And by the end of the day, you end up getting out here for a small winner. And on the other ones, it trends. And so then you get a huge winner, and you'll get a few like this one where you get stopped out. So part of the reason you get that rush to the downside, whenever you've got a very directional open, you can't get more directional than Fridays. As soon as you go back through the open, people run for the exits, or well, less run for the exits, people start getting hit. And that's partly what creates that rush down. So that's the other reason for me saying it's very technical. The other thing that makes you think it's technical as well is it drops straight into previous value, trades straight through previous value and stops. It doesn't go anymore, doesn't do anything else, it's just into value and then trade in that area. That's what makes me think it's very, very technical. That then leaves us today with a very distinct area of light volume, a very distinct single print in the middle. And this is, I always think these are quite easy ones to turn into a trade idea. Pretty straightforward. As long as it stays out of the single prints, this can go up and you could look towards yesterday's high. If you fall into the single prints, I would assume it's going to go and trade through them. So a minimum to 58, 57 area. The fact that you've got the volume all the way down here, it would not be unreasonable to play to 45 as well. And then you assume that what you end up doing is at the end of the day, balancing like that. So you end up with a profile that looks something like that, a kind of half a pair, if you will. That's what I would assume if it goes down. If it doesn't get inside here, which is roughly what it's done so far today, it's traded, 67, I think? Ticked into 57, 67s. You can now assume movement towards the upside. This is what I was saying about that, the single print. The fact that we've traded down here already, if this breaks the upside, I'd be much more inclined to think to myself, the breakout is the beginning of a set of single prints before a continuation move up, rather than assume it's a tail on the upside. That's my perspective on it. Of course, somebody could also have said that when it went down and played the short on it towards the downside. So I always say you've got to at least give yourself a degree of bias and go, well, I think this is a good support. Therefore, I'm not going to play for the break and move through. If it's going to fall in and fill this area out, I'd prefer to buy it here or here and play for it to fill that back out than I would try and sell it here, because I don't believe that it's necessarily going to do it. I prefer to buy it there and try and play for the move up. You've got to come to those conclusions yourself. You've got to make your decision. If you're super, super bearish S&P, you're selling the 67s all day long, thinking, yeah, this is going to fall. If you're not that bearish S&P, then you buy it and play it towards the upside. But they're usually quite nice ones. If it had opened in the middle, so the S&P had opened here, I would have straight away been saying, you offer 73, bid 45, and that's it. You just have an offer there, bid, and you assume that it's going to do that. It won't do it perfect. Be a lovely day if you just go bid, filled, offer, filled, reverse, 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 and it does it all day long. It never does. The reason it doesn't is because, well, once it's traded down here, if it holds, anybody who now wants to buy looks at it and thinks, well, it might not go back there. So if you've got to buy, rather than us who would like to buy at a really good price, if you have to buy, you're going to go, do you know what, I'll pay 48 to make sure I've got the business done. So therefore, people's bids start to move up. If you've got to sell, you then go and offer 70 to make sure you get filled. You always got to remember that there's a lot of people who are not us, whose focus is on actually getting the business done. We don't have to trade. You don't have to buy it, so you're much more price sensitive. You don't buy something that's not the price you want. Somebody who's got to buy, because a client said, I need you to buy me 5,000 Bund by the end of the day, or S&P by the end of the day, below 50, you might look at that and think, it's traded 45 and bounced. Anything below 50 is good now. And so you then buy 49, 48, 47, and anything around there. So that moves the bids up. That keeps it nice and compressed, but it also means you're unlikely to get filled multiple times at the extremes. You'll probably get there, get it once. If you do, take it back to the middle. I always say go back to the middle. The idea behind that is it doesn't have to go to the other side, but if it does go to the other side, it has to pass the middle. So you bank your money, and then move on and try and play it back the other way. There you go. For the initial balance, is it ignored until cash session appeared or used from the previous day? You can't use yesterday's initial balance because that was yesterday's. You have to look at today's initial balance, and pre-cash session, I would say don't look at it. Good example of that is something like the euro. You'll come on to initial balances tomorrow. The initial balance is the little dark blue, not the green bits. The green is 100% initial balance, but this is a good illustration. The basic interpretation of initial balance, real simple, is the smaller it is, the more scope for a trend day. The larger it is, the less scope. On a large initial balance, you also don't expect to exceed 100% of the initial balance. 100% of the initial balance is the green. The euro does it every day without fail. Because if you're looking at a 24-hour session or full session, your initial balance is the middle of the night, the very beginning of the Asian session. So there's a lot of different areas around the world that are not trading at all. So you've got, I can't even think what would be open at that time, a few Australians, and that's about it. So until you then start getting Japan and move across Asia and towards Europe, volumes don't really pick up. So you always end up with these tiny initial balances, which you could interpret and go, oh, trend day. But you've had these all the time, and you very rarely see these turn into trend days. With currencies, I don't know if this came as a question, somebody has asked it though. There is no cash session on currencies, so you kind of have to go 24-hour. I'm more interested in the shape of the profile, i.e. we have opened lower and closed higher, value's not quite shifted up, so I'd assume it will fall back, which is what happens the next day. Similar though, you've closed lower with value higher, I would assume that you go back up here at some point. But I'm more interested in the shape of the profile than I am the initial balance itself. I've heard various different interpretations of how you could do it. You could treat the initial balance as the entirety of the Asian session. You've got to be careful with that applies if you're trading, say, euro dollar or sterling dollar, but absolutely doesn't if you're trading yen, because that's a key part of their day, right? So you've then got to change all of these based on different currencies, which I think becomes a bit, there's too much complexity, because also you've got to factor in that whilst, yes, dollar yen, for example, Japan opens way earlier than Europe, most currency trading is done in London. So you still get a greater amount of volume in the European/US session than you do in the Asian, despite the fact that it's Japan against dollar. Maybe different if you look at, say, Aussie yen, you might get something slightly different there in terms of volume profile throughout the day, but I'd still expect a lot of volume to get done in the European session. So on that basis, completely ignore initial balances on currencies, completely ignore them if you're looking at a 24-hour profile of anything. On an initial balance though, it has to be on the current day. The reason for that being, the current day's initial balance is people's sort of initial action. It's the kind of setting the tone of the day. Obviously, that's not what people think when they trade in the first hour of, oh, I'm going to set the tone for the day. But if somebody shows very early on they've got a lot to buy, and nobody comes back against them, i.e. you get a clean move in the initial balance, that sets the tone that there are people who want to buy and there are not many people who want to sell. The market's now got a direction. If you have a small initial balance, the interpretation of that is, well, no one's decided yet. It could mean that you still don't do much, but if you then do get some direction established, the fact that somebody, buyers or sellers, have decided to then start to implement a buying or selling kind of strategy for the day, then that becomes the movement of the day. The nice thing about small ones is there's still a lot of space to go. The bad thing about big ones is by the time you go, oh, it's a big initial balance, well, most of the day's range is done. Doesn't mean the days are rubbish, because you still get quite a lot going on. It just detracts from directional continuation. So you could still have a large initial balance and a lot of range, but it's not going to extend that range beyond the initial balance very far. I'll perhaps talk about that a little bit more tomorrow. So yeah, Darius, there's no point in looking at yesterday's IB. Yeah, yesterday's IB and the S&P, the only reason that coincidentally I'm kind of looking at it is that that was the beginning of the single print and it was the high of the day. But it's to do with the fact it's the high of the day in the single print, not to do with it was yesterday's initial balance. Today, so far, I would put the S&P as having a reasonably small initial balance, i.e. has not made its mind up yet, which is good because that does suggest that, well, when it does, minimum, you'd expect it to reach the peak of the greens, but this is a small initial balance. The way I'd say it's small, I'm not one for measuring the sizes of all these or trying to find an average size initial balance, because when volatility goes up, I've seen the S&P do 100 handle initial balance. If you saw one of those now, you'd be like, wow, that's the biggest IB of the year. It probably is, if you ever saw one. So it's almost a case you can kind of eyeball it and you go, well, it's certainly smaller than that, it's smaller than that, that. It's small-ish. It's not tiny, but it's pretty small. Therefore, I would be reasonably confident, particularly on the upside, particularly as we opened high and traded down, on that principle. If people are selling the open, playing down, they're all going to stop out on the upside. So I'd be quite confident if it does break up in particular, that is one you can go with the break and expect continuation. It's just you want to see it get on with that sooner rather than later. The longer it takes, usually the quieter the day becomes. Right. Whilst not strictly profile orientated, I thought I'd bring this one up in oil. And if anyone didn't trade this, one to go and have a look at when you've got replay. You get replay next week. So this is oil off the open today. The idea of the trades, we were discussing it in here, was break 72, which you could have called a double bottom, you call it whatever you want. Also, from a profile perspective or a positioning perspective, oil sold off. We know that it had that big gap down. And from a cash perspective, oil's gapping down by opening down here. I think it's gapping down about 300 ticks. You expect on the open this to open a rush down, which is what it does. Then it's a case of, does it continue? If it rushes down, think about what people are going to be doing. The people who sold this on the open in the overnight. If you sold this at 11 o'clock at night, or 10 o'clock last night, and you've then sold it at 69.50, somewhere like that, you're pretty happy with yourself here. When this rushes through the low, you're now thinking, this is the one. Gap down cash session, it's going to drop. If it doesn't, chances are you would have tightened your stop to back above the overnight session lows. So that's then what starts pushing people out of the trade. Equally, it could be a lot of people who go, well, let's just hold it to the cash session, and if it rushes down, just get out on the way down, which stops the drop as well. So that's happened. You're back up above 14s and 18. Here's the chance for the move higher. Now, the bit of where you think it's really going to move, or the bit that I thought, was break 72 here, and you can go up to that 68.14. The point I want to make here is on what I call a should versus an actual trade. There's a difference between what you think should happen and what actually happens, and that then has to factor into whether you stay in the trade or not. So my expectation on this, what I thought should happen, is this should break 72. You've got a little bit of risk here, up to say 83, this range, that it could roll back. But my expectation was then at 83, this should just whiz up very fast. Sort of liquidation type move. Anyone who'd stayed short surely gives it up. This is one where you have to make a decision in terms of when you're in that trade as to whether this is doing what you think it should do versus is just technically going there. When it got up here, it did a lot of volume above 72 and it never pushed and pushed and pushed. So when that happens, you're then slightly stuck in the sense that you have to look at that and go, well, do I really believe this is going to do it? Because it's not what it should have done. What it should have done was trade up here, trade 79, which is the low of the initial spike down, trade 83 and whiz up. 10 minutes later, it's traded in a range of about 80 to 65, I think it was, which is this little range here. I don't think there's anything wrong if you bought 72, giving that up in the mid 70s and go, well, this isn't what it's supposed to be. Yes, you might kick yourself when it has now traded up here, but you're sitting there for probably the best part of an hour, if not longer, looking at the uncertainty of, well, this isn't what it's supposed to do. It doesn't look right. Should I really stay in the trade? And like I said, I don't think there's anything wrong with giving that up. The other way of doing it is you just go, well, it is up there, put your stop there. But from a probability perspective, my view would be the longer it sits here, the probability of going to a 62 stop versus a 14 target becomes more like 50-50. When it first broke, my view is tick over 83, and this is 90% probability of going to 14 versus 62. It's almost a banker. The longer it spends sitting there, you have to then weigh that up. Are you now happy to accept a 50-50 chance? Yes, the payout's still all right, but it's very 50-50. And if you were looking for it to do a specific thing, you can't trust it. You can't size up on it either. If you bought 72, you bought 79 for the break and it doesn't go, I think you have to then scale that back down and say, well, I'll stay long 72 and just play the pure technical, 72 up, stop at 62, and reduce the rest of it because it's not doing what I want. Or, well, I don't think there is an or. I mean, you just have to give that one up, cut it down, move on. Frustrating, but they're the ones that you also then have to be quite clear in your mind that it's not what you thought, therefore it's not a good idea, rather than it ends up going there and you end up being frustrated. I guess it's like if you go into a car garage and you go, right, I've got a family, I need a 4x4, I need it to do this, 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 and the guy goes, yeah, but we got this 2-seater convertible. And you go, well, it's still a car, get in it, great, it will get you where you want to go until you need it to do the other things. So it doesn't achieve the purpose it should, or well, you know what it should do. What it actually does isn't it. It's whether you then just stay in and accept that or not. So yeah, I think that was a really difficult one in terms of the way you did it. I don't mean you'd be wrong to have given it up. I also don't think you'd be wrong to have stayed in and gone, well, I'm just going to stick my stop and leave it. As long as you're consistent, I think it's the key bit with that. Consistent in your approach and your way of doing it. If you give them all up when they don't look like the way they should do, that's fine. If you stay in and go, well, technically it's fine, so let's see if it works, I don't think there's a problem with that either. You just want to be consistent in which, so that you're not stuck going, well, I stay in this one, and then you give up other ones. You're not going to get the same results. It's hard to then understand whether the idea is good or not. Right. We'll quickly wrap up on where we are with a few different things. Feels like everything's kind of stagnated a bit now. Bund has still left us there. S&P and...
It's very exciting the whole time.
Oil's exciting?
It was the whole time you were talking that.
Yeah, it's kind of died off now. I think in terms of day types, if I was just looking at the profiles where you are now, oil to me looks like a market that's roughly set the tone. It's decided what it wants to do. It's not a drastically large initial balance, but it's still pretty hefty. It's 100 ticks nearly. I would be quite surprised if you managed to get all the way up to 80, 68, 90, 68, 80. I would expect now just rotation here. So from that perspective, if I'm imagining that this is just going to turn into a kind of what you call a normal day, which we'll cover tomorrow. If you think this is going to be a normal day, well, anything that comes back down here into the sort of 67.50 area, if you can find a buy there, 38s, I think, 38, 39 area down here, you could play it back to the upper part of the range. I wouldn't go trying to play, say, a long expecting to go breaking the high. Anything up in the kind of 68, double O's area would seem quite a reasonable target. And so you then end up with this kind of just playing it up type approach. I think the Bund has pretty much told you everything it's going to do. The only thing you've got left for me in the Bund now is whether it holds this single print and you can play it up to try and break the high one last time on the day, or it breaks the single print and rolls down towards the sort of 0095 area. This is a really ugly point in the sense you could buy that and get stopped out here. You could sell it and get stopped out here. So I think you could do it and just go, well, I'm calling this a buy here, play it for the move. But the reason I say I don't like it is if it ends up being the one that moves down, it could end up, if you imagine it sort of balancing the profile out there, therefore it's going to have to trade across this area quite a few times, which could mean it goes down to here, it may only go to here, it may go all the way up, it may not. You're kind of right in the middle of this uncertainty zone.
It was beautiful on the price ladder, but the profile's just ugly. The whole day is just ugly. I mean, it's not the worst, but...
Well, the burn, I think the profile's really nice.
Oh, okay.
In the sense it's quite clear, there's very distinct pockets in it, which is what you want. There's single prints that hold, all of those bits are really nice. Yeah, even down to this bit here, you can see the light volume on the ladder. So if you like the idea of this being a buy, and you could do it as what I call a cheap trade. You could buy 17, put your stop at 13 and go, well, I'm going to play this for the mid 30s. It's a reasonably small stop. It's a cheap trade to do. Do I think it's really high probability of working? No. But equally, I wouldn't be surprised if it does. Yeah, I think it's one of those 50-50 ones. Downside, it's a harder one to play down at the moment. Huh?
Bit of a gambler.
Well, sensible. Yeah, for a 4-tick risk and a,
No, it's fucking right.
yeah, it's 4-to-1 risk reward. It's just one.
50-50 is a good chance we manage a risk like.
Well, it's a 50-50 shot at a 4x payout. Yeah, in a 2-horse race, if someone offered you 4-to-1 on a horse, unless it's only got 3 legs, you'd probably best bet on it. So I look at it like that.
Actually, never really gambled that one.
Well, there you go. You get to horse races.
Once I get some money from trade, I'll load all the horses in.
That's probably not the best idea. Or you can look for more surefire bets, or things that I think have got a greater probability of working at a distinct point, which I think the S&P probably has.
I'd rather trade.
There you go. I think you've still got a pretty straightforward, whichever way it breaks, you could play that direction. The consideration here is if it is going to be the fill the cave in, as I would call it, on the double distribution, if you play the breakdown, your payout possibly isn't that big, in the sense it could just break down, hit 60 and then rotate back up. So you have to accept that you're not going to get a particularly big payout, and you're going to have to make a decision quickly here as to which it is. If it breaks the high, I think you could have a similar type of movement to this one yesterday. It's also breaking above yesterday's value. I think that's a reasonably fair one to shoot for the high. So then you've got a clearer and bigger target on the upside. You've probably got a swift move, but a smaller target on the downside. And then it's going to be a case of as well how the rest of the day plays out. If it goes down, I think you just end up with a profile that gets traded out here. So you end up with this kind of fat profile here. If it goes up soon rather than later, then I think you could have the possibility of a trend move, or even if not a trend move, a kind of quick liquidation, a bit like this. Quick move to yesterday's high and then give it up and go, well, I'm not sure from here. That's how I always, part of looking at profiles, just always sort of think, well, what could this look like at the end of the day? And if it is going to look like that, what's got to happen? And where's the move that is going to be clean to trade? If this is going to trade up and down in this area, well, at one point it's going to have to go through it. And so probably the first time is the best time, because after that, if it's just going to up and down this, it's just going to do it in a kind of steady rotation. So that's how I would interpret that. So we'll see. Everyone can come in tomorrow and say how they absolutely smashed it in the S&P, selling the break of the low.
I don't have internet at home, otherwise I'll probably get.
Hmm?
I don't have internet at the moment, so I can't trade tomorrow.
Oh, see here and there. You'd expect it to do it sooner rather than later. The longer it takes, the less valuable this trade's going to be.
I'll bring my swag tomorrow and I'll just camp here for the week.
There you go then. Right, I will wrap it up there. I'm not seeing any other profile based questions. So yeah, we'll catch you all tomorrow. End of this week, we're going to do a profile based task as well. So I will set that up on Friday. We've also got payrolls on Friday as well. It's a good order flow one to have a go at. So go and have a go at payrolls. Do tasks, but have a go at payrolls. You know, there's no better chance to learn than doing something when it's not going to cost you. Go and have a go at it. Right, I'll see you all tomorrow.